Well to channel and silver John market, all right. I need you to stop whatever you are doing right now. Put down your phone, close that other tab, pause whatever podcast is playing in the background, because what I am about to tell you could literally save you thousands of dollars, or if you are on the other side of this, could make you the kind of money that changes the direction of your financial life. I am not exaggerating. I am not doing the clickbait thing where the actual content of the video has nothing to do with the thumbnail. What I am about to walk you through is something I wish someone had sat me down and explained before I ever bought a single ounce of silver. And I bought a lot of silver before I understood what I am going to share with you today. So here is the deal. Silver is having a moment. You have probably noticed that. If you have been anywhere near a financial news website, a Reddit forum, a YouTube channel, or even just a conversation with someone who is slightly into investing, you have heard the buzz. Silver is cheap. Silver is undervalued. Silver is the greatest opportunity of the decade. The silver to gold ratio is at historic extremes. Industrial demand is going through the roof. Solar panels, electric vehicles, 5G technology, semiconductors, all of it requires silver. The case sounds airtight, it sounds undeniable, and honestly, parts of it are true. But here is what nobody is telling you, and here is why I filmed this video, because there is a version of this story that ends with you holding a bunch of silver that you do not fully understand, having paid prices you did not need to pay, through channels you should have avoided for reasons that were not as solid as the YouTube thumbnail made them sound. I have been studying precious metals for a long time. I have talked to dealers, refiners, fund managers, industrial buyers, and regular everyday investors who bought silver at 48 an ounce in 2011 and are still waiting to break even. I have made mistakes in this space myself. And I want to be the guy who gives you the real information, not the polished sales pitch, not the doom and gloom survivalist angle, not the dollar is about to collapse, so buy silver narrative that has been repeated every single year for the last 30 years without the dollar actually collapsing. I want to give you the full picture. The honest, complicated, nuanced, sometimes uncomfortable full picture. Because that is what you deserve before you put your hard-earned money into anything. So let's start from the very beginning. Let's talk about what silver actually is in the context of investing. And I mean really talk about it, not the surface level. It's a precious metal with industrial uses. Summary that you have heard 1,000 times. Silver is genuinely one of the most interesting and confusing assets that exists. It sits in this weird in-between space that no other commodity really occupies. On one hand, it is a monetary metal. Human beings have used silver as money for literally thousands of years. Long before paper currency existed, long before central banks existed, silver was what people traded for goods and services. It has real intrinsic cultural and historical value as a store of wealth. Governments used to back their currencies with it. People still carry American silver eagles because they are legal tender, even if no one is actually using them at a vending machine. That monetary history is real, and it matters in terms of psychology and perception. But here is where silver gets strange. Unlike gold, which is primarily a monetary and store of value asset, something like 90% of all the gold ever mined is sitting in vaults, jewelry, or central bank reserves. Silver gets consumed. It gets used up. Industrial processes use silver, and in many cases that silver is not recovered. It ends up in landfills, in electronic waste, in chemical compounds that are too diluted or too expensive to refine back into usable metal. So, unlike gold, which the world has been accumulating for thousands of years, silver's above ground stockpiles have actually been declining relative to demand. That sounds bullish, and in some ways it is bullish. But it also means silver is responding to industrial economic cycles in a way that gold just does not, and that creates a layer of volatility and complexity that most casual investors are not prepared for. Think about what happened in 2008. When the financial crisis hit and the global economy started contracting, silver absolutely cratered. It went from around $20 an ounce down to below $9. At the same time, the narrative around silver was that it was a safe haven, that it would protect you, that it was real money, and for a period of months, it acted exactly the opposite of that narrative. It got obliterated. Gold held up relatively better because gold's demand is more stable and less industrial. Silver, with its huge industrial demand component, got hammered because investors were pricing in a slowdown in manufacturing, electronics, construction, all the things that use silver. So if you had bought silver as your crisis hedge, you would have watched it drop by more than 50% during the actual crisis. That is not what most people selling you the silver narrative tell you up front. Now, did silver recover? Yes. Did it eventually go on to hit nearly $50 an ounce by 2011? Absolutely. But that brings me to the other thing that almost no one talks about honestly, the timeline. Because investing in silver and being right about silver are two completely different things, and the gap between being right and being right at the right time can span decades. There are people who bought silver in 1980 when it hit almost $50 an ounce during the Hunt brothers' attempted market corner, and if they held that silver in nominal terms, they did not get back to even until 2011. That is 31 years. 31 years of holding a physical asset that paid no interest, no dividends, required storage, potentially required insurance, and returned nothing nominally. In real, inflation-adjusted terms, the loss was even worse. So yes, silver went from under 10 to nearly 50 years between 2008 and 2011. But if your entry point was 1980, that run meant almost nothing to you in real terms. I tell you this not to scare you away from silver permanently. I tell you this because the number one thing that separates sophisticated investors from people who get burned is time horizon clarity. Before you buy anything, you need to know what your timeline is, what your expectations are, and what role this asset is supposed to play in your overall financial life. And with silver, that question is especially critical because the forces that drive silver's price are genuinely complex and sometimes contradictory. Let me walk you through the bull case for silver in a serious way, because I want to be fair to both sides of this. The industrial demand story is real and it is growing. Solar panels use silver, a lot of silver. Each solar panel requires a significant amount of silver paste for its photovoltaic cells, and with the global push toward renewable energy, solar installation is expanding at rates that are genuinely staggering. The International Energy Agency has published projections showing solar as the dominant new source of electricity generation globally over the next 2 decades. That is a massive, growing source of industrial silver demand that did not exist at this scale 20 years ago. Electric vehicles are another big piece of this. EVs use significantly more silver per vehicle than traditional internal combustion engine cars because silver is used in the electrical contacts, sensors, battery management systems, and other electronic components that an EV relies on more heavily. As EV adoption scales, and it is scaling, even with some of the speed bumps the market has encountered, that demand for silver scales with it. Then you have 5G infrastructure. Silver is used extensively in the electronics and connectivity equipment that makes 5G networks function. The rollout of 5G globally is still very much in progress, and as it expands, that represents another demand driver. Add to all of this the broader explosion of electronics manufacturing. Every smartphone, every laptop, every server, every piece of medical equipment, every defense system, and you are looking at a metal that the modern technological world genuinely cannot function without. There is no good substitute for silver in most of these applications. It has the highest electrical conductivity of any metal. It has antimicrobial properties that make it valuable in medical contexts. It reflects light better than any other metal, making it essential in certain optical applications. These are not made-up use cases. These are real, documented, growing industrial needs. And on the supply side, there are real constraints. Most silver is mined as a byproduct of other metals: zinc, lead, copper, gold. Only a small fraction of global silver production comes from primary silver mines where silver is the main product being extracted. This means that silver supply does not respond to price signals the way you might expect. If the price of silver doubles, the primary silver mines benefit and might increase production. But the byproduct silver from zinc mines and copper mines, that production level is determined by the economics of zinc and copper, not silver. So if zinc demand falls and zinc mining slows down, silver supply contracts even if the silver price is screaming higher. That supply inelasticity is a genuinely interesting structural feature of the silver market that supports a long-term price argument. On top of all of this, there is the monetary hedge argument. Silver, like gold, is often positioned as a hedge against currency debasement, inflation, and the erosion of purchasing power that comes from central banks printing money. The argument goes that fiat currencies can be created in unlimited quantities by governments and central banks, but silver exists in finite amounts and cannot be printed into existence. Therefore, over long time horizons, silver should maintain or increase its purchasing power relative to fiat currencies. The historical record on this is actually mixed and depends enormously on your time horizon and entry point, but there is a kernel of truth in it. Silver does have a track record, over very long periods of time, of holding value in ways that paper money does not. So the bull case is real. I want you to understand that. I am not dismissing silver as an asset. What I am doing is giving you the other half of the story that the people selling you silver often leave out. Here is where things get complicated. Let's talk about price manipulation, because you cannot spend 5 minutes in silver investing circles without someone bringing up the idea that silver is being manipulated lower by big banks. This narrative is pervasive and emotionally compelling. The idea is that JP Morgan and other major financial institutions are using the futures market to artificially suppress the price of silver, keeping it far below its true value, and that one day the dam will break and silver will explode to hundreds or even thousands of dollars per ounce. There are people who have built entire media careers around this narrative. There are books, podcasts, newsletters, YouTube channels, and conferences dedicated to it. Here is what I will say honestly: there have been proven cases of manipulation in commodity markets, including precious metals. JP Morgan was actually fined by the Department of Justice and paid over $920 million in 2020 to settle allegations of manipulating precious metals futures markets through a practice called spoofing, placing large fake orders to move prices and then canceling them. That happened. It is documented. It is not a conspiracy theory. So the people who say manipulation exists in silver markets are not wrong that manipulation has occurred. But, and this is a critical but, the conclusion that silver is therefore massively suppressed and that the true price is hundreds of dollars per ounce is a leap that the evidence does not necessarily support. Markets are complicated. Manipulation in futures markets can affect short-term price movements without necessarily determining the long-term equilibrium price of a commodity. And the people who are most loudly and consistently making the extreme manipulation argument are often the same people who are selling you silver, selling you newsletters about silver, or running websites that monetize through silver-related advertising and affiliate relationships. I am not saying they are lying. I am saying you should understand their incentive structure before you allow their analysis to be the basis for your financial decisions. The silver manipulation narrative has been loudly promoted for at least 20 years. During that time, silver has been below 5,000 an ounce, it has been above 49 an ounce, and it has been all over the place in between. The people who said in 2011 that silver was going to 100 or 500 because of manipulation have not been right. Not yet. Maybe someday they will be, but maybe someday is not an investment thesis. It is a hope, and there is a difference between hope and strategy. Let's talk about something practical now, the premium problem. Because even if you are completely right about silver's long-term direction, you can still lose money or significantly underperform if you do not understand how premiums work. When you buy physical silver, coins, bars, rounds, whatever, you do not pay the spot price. You never pay the spot price. You pay the spot price plus a premium, and that premium varies enormously depending on what you are buying, where you are buying it, and what conditions in the market look like at the time. In normal market conditions, a standard 1-ounce American silver eagle coin might carry a premium of $3,000 to $5 over spot. A 1-ounce silver round from a private mint might be $1.50 to $2.50 over spot. A 100-ounce silver bar might be $0.50 to $1.50 over spot. These are rough numbers that vary constantly, but they give you a sense of the landscape. Now here is the thing, those premiums represent a headwind that you have to overcome before you even start making money. If you pay $5 over spot for a silver eagle when spot is at 25, you need silver to rise to at least $30 before you break even, and that does not even account for the spread between the buy price and the sell price when you eventually sell. Because dealers buy silver back at a discount to spot. Always. When you want to liquidate your silver, the dealer is going to offer you something below the current spot price. Maybe $0, $50 under spot for common rounds, maybe $1 or $2 under spot for coins, depending on the market. So you have a spread working against you on both ends. You paid above spot to buy. You will receive below spot when you sell. Silver needs to move significantly in your favor before you are actually profitable, and the more premium you paid up front, the farther it has to move. This problem becomes absolutely brutal during periods of high market stress, which is often exactly when casual investors are running into silver dealers for the first time. When there was a buying frenzy in 2020 and 2021, driven by Reddit's Wall Street silver community, premiums exploded. American silver eagles were selling for 10, 12, even 15 over spot. People were paying $40,000 for an ounce of silver when spot was 25 or 26. Dealers were struggling to keep inventory. There were wait times of weeks or months, and people were paying these insane premiums because the FOMO was overwhelming and they did not fully understand what they were doing. Those people are now sitting on silver they bought at a massive premium, waiting for the spot price to catch up to what they actually paid. And some of them are starting to understand that even if silver goes to 35 an ounce, they might still be underwater because of the premium they paid and the spread they will face when they sell. I am not telling you this to make you feel bad if this happened to you. I am telling you this because knowledge prevents this mistake. If you understand how premiums work before you buy, you can be patient. You can wait for the frenzied periods to pass and buy when premiums compress. You can comparison shop between dealers. You can choose lower premium products when appropriate. You can build your position strategically rather than emotionally. Let's talk about the different ways to get exposure to silver, because physical coins and bars are not the only option, and for many investors, they are not the best option. I want to walk you through the full menu so you actually understand what is available and what the trade-offs are. Physical silver, coins, bars, and rounds is what most people think of first. The appeal is obvious. You have something tangible. You can hold it in your hand. It cannot be hacked. It cannot go bankrupt. It does not depend on anyone else's promise to pay. If the financial system has some catastrophic failure, you have a real asset that has held value for thousands of years. These arguments are legitimate, and for a certain type of investor with a certain set of concerns, physical silver absolutely makes sense. But physical silver has costs. It has to be stored. If you are storing it at home, you have a security concern and probably need a safe. If you are storing it at a third-party facility, you are paying storage fees. It is not liquid in the way that a stock or ETF is. You cannot sell it with a click. You have to find a buyer, deal with shipping if it is not local, get an appraisal, etc. And as I just explained, you are always working against a buy-sell spread. Silver ETFs, particularly SLV and PSLV, offer a completely different experience. You buy shares of the ETF through your brokerage account, exactly like you would buy a stock. The ETF holds physical silver in a vault, and the value of your shares tracks the silver price minus a small management fee. The advantages are enormous in terms of liquidity and convenience. You can buy or sell in seconds during market hours. You have no storage concerns. You pay no premiums over spot. You pay the spot price more or less. The management fees are low, typically a fraction of a % annually. For most investors who want exposure to silver as a portfolio allocation, an ETF is dramatically more practical than physical silver. But ETFs have their own concerns, and the hardcore silver community hates them with a passion. The argument against silver ETFs is that you do not actually own silver, you own a piece of paper that represents a claim on silver. In a true financial catastrophe, the ETF structure could theoretically fail. The custodian holding the silver could have problems. There are questions in some corners about whether ETFs are fully backed by the physical silver they claim to hold. These concerns are not entirely without foundation, though most professional analysis suggests the major silver ETFs are legitimately backed. But if your reason for owning silver is specifically to have something outside the traditional financial system, in a worst-case scenario, an ETF defeats the entire purpose. You are back inside the financial system. There are also silver mining stocks, companies that mine silver and whose stock price tends to be leveraged to the silver price. When silver goes up 10%, a silver mining stock might go up 20% or 30% because the profit margin of the mine expands dramatically. This leverage works in both directions. Mining stocks can fall much faster than silver itself when silver drops. Mining stocks also carry company-specific risk management quality, mine quality, geopolitical risk of the country where the mine is located, labor disputes, environmental regulations, operating costs, and a dozen other factors that have nothing to do with the price of silver. Owning silver miners is very different from owning silver, and I think a lot of people blur that line in a way that gets them into trouble. Then there are silver futures, contracts to buy or sell silver at a specific price at a specific future date. Futures give you enormous leverage and are primarily used by professional traders and institutions. For retail investors, futures are genuinely dangerous unless you really know what you are doing. The leverage amplifies losses just as readily as gains, and you can lose more than you initially invested. I mention futures only to complete the picture. For most people watching this video, futures are probably not where you should be starting. And there are also silver options, silver streaming companies, silver royalty companies, and various other ways to get exposure. Each has its own profile of risks and rewards. The point I want to make is that saying, I want to invest in silver, is only the beginning of a decision, not the end of one. The how matters enormously. Now let me talk about something that I think is genuinely underappreciated in the silver conversation, and that is the psychological dimension of owning physical silver specifically. There is something that happens to people when they start accumulating physical silver that I have observed many times and experienced myself to some degree. It becomes addictive in a way. The community around silver is passionate and enthusiastic and sometimes almost cult-like. There are YouTube channels, subreddits, forums, meetup groups, coin shows, an entire social ecosystem built around silver stacking. And the culture of that world can, if you are not careful, start to override your rational financial thinking. The narrative gets reinforced constantly. Every video tells you that silver is about to explode. Every forum post tells you to buy the dip. Every conversation at the coin show confirms your belief that you are the smart one who sees what the mainstream does not. And slowly, without you even realizing it, you can find yourself allocating more and more of your portfolio to silver, not because your financial analysis has changed, but because your social environment is telling you to. This is not unique to silver. It happens in crypto communities, it happens in real estate investment clubs, it happens in stock picking forums. But the silver community is particularly intense about it, and I think it is worth naming directly. A healthy portfolio allocation to silver, if silver belongs in your portfolio at all, is probably in the range of 2% to 10% for most investors, depending on your goals, risk tolerance, and specific circumstances. I have seen people who have 60%, 70%, 80% of their net worth in physical silver. That is not diversification. That is a concentrated bet. And while it could work out spectacularly if silver has the kind of run that the most bullish people predict, it could also be a long, painful decade of waiting if timing does not work in your favor. Concentration risk is concentration risk, regardless of how compelling the narrative sounds. Let's talk about the tax implications of silver, because this is another area where a lot of people get surprised. In the United States, the IRS classifies precious metals, including silver, as collectibles. And collectibles are taxed at a maximum long-term capital gains rate of 28%, which is higher than the maximum long-term capital gains rate of 20% that applies to most other investments like stocks. And that 28% applies if you hold for more than a year. If you sell silver within a year of buying it, the gains are taxed as ordinary income, which for high earners could be even higher. This is not a reason to never own silver, but it is a real cost of ownership that affects your after-tax return and should absolutely factor into your decision-making. Some silver ETFs may be treated differently depending on their structure, so if tax efficiency is a concern for you, and it should be, consult with a tax professional about the specific vehicles you are considering. Holding silver in a retirement account like an IRA can also have implications, including that you generally cannot hold physical silver in a traditional IRA without going through a self-directed IRA with an approved custodian and storage facility, which adds complexity and cost. I want to spend some time on the historical price performance of silver because I think the data tells a story that is more sobering than what you typically hear in silver bullish content. Let's look at some numbers. In January of 1980, silver hit a peak of around $45 an ounce, driven by the Hunt brothers' attempt to corner the silver market. That peak was extraordinary and driven by circumstances that are unlikely to repeat. After the Hunt corner collapsed, silver fell precipitously and spent most of the 1980s and 1990s in a range of $3.50 to $80 per ounce. For 20 years after that 1980 peak, silver was a miserable investment in nominal terms and a catastrophic one in real terms once you account for inflation. Silver then began rising in the early 2000s along with other commodities during the commodity supercycle. It went from around $4,000 in 2001 to a new peak of around $49 in April 2011, 3 decades after its previous peak of similar magnitude. From 2011, it fell hard again, hitting lows around 14 in 2015 and 2016. It recovered somewhat, then had a spike to 29 in 2020 during the pandemic, then pulled back, then gradually worked higher. As of the time I am recording this video, silver is trading in a range that represents significant gains from its 2015 lows, but is still well below its 2011 peak in nominal terms and far below it in real, inflation-adjusted terms. The conclusion I draw from this historical picture is not that silver is a bad asset. The conclusion I draw is that silver is a volatile, cycle-driven asset that requires either excellent timing or an extremely long time horizon to be a reliable wealth builder. If you bought silver in 2001 and sold in 2011, you made extraordinary returns. If you bought in 2011 and held to today, you are still waiting to break even in real terms. The price at which you enter matters enormously, and the timing of that entry is genuinely difficult to predict with any reliability. This is actually one of my core arguments for why it is worth understanding silver deeply before buying it. Not because you want to time the market perfectly, but because understanding cycles and valuation helps you avoid buying at obviously extended prices and helps you accumulate intelligently during periods of weakness when premiums are low and sentiment is pessimistic. The silver to gold ratio is a metric that a lot of serious precious metals investors follow, and I think it is worth understanding. The ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, going back thousands of years, the ratio has averaged somewhere around 15:1, meaning 15 ounces of silver equaled 1 ounce of gold in value. In more recent modern history, the ratio has generally traded between 40 and 80, with spikes to extremes. At the peak of the COVID market disruption in March 2020, the ratio hit around 125:1, meaning you needed 125 ounces of silver to buy 1 ounce of gold. That was an extraordinary extreme, and silver subsequently outperformed gold significantly as the ratio normalized. The bull case for silver often leans heavily on this ratio, arguing that when the ratio is high, as it has been in recent years, often trading between 80 and 90, silver is historically cheap relative to gold. The mean reversion argument says the ratio will come back toward historical norms, which would imply silver significantly outperforming gold. This is a coherent argument, and there is historical precedent for it. But the ratio can also stay at extreme levels for extended periods, and mean reverting to historical average is less compelling when the historical average is calculated over thousands of years during which the monetary and industrial contexts were completely different. Still, if I had to pick one metric to watch as a gauge of silver's relative value, the gold to silver ratio is probably the most useful one. Buying silver when the ratio is extremely high, say above 90, and rotating toward gold when the ratio is extremely low, say below 40, has historically been a reasonable strategy for precious metals investors with long-time horizons. It is not a guaranteed winner, but it is a thoughtful framework. I want to address the collapse scenario case for silver because it is widely promoted and I think it deserves honest examination. The argument goes like this: the global financial system is fundamentally broken. Governments are running unsustainable debts. Central banks have printed enormous amounts of money. The dollar is eventually going to lose its reserve currency status. Inflation is going to spiral. The whole system is going to come apart at some point. And when it does, paper currencies will be worthless, digital assets will be inaccessible, and the only things that will matter are real, tangible assets: food, water, land, gold, and silver. This scenario is emotionally compelling, and elements of it are based on real concerns about fiscal and monetary policy. But let me offer some honest pushback. First, this scenario has been predicted confidently by serious, sounding people for decades and has not materialized in any of the predicted timelines. That does not mean it is impossible, but it does mean that eventually this will happen. It is a very long, dated bet that has been very costly to people who have been positioned for it since the early 2000s or earlier. Second, if you are genuinely preparing for a complete societal collapse where the financial system ceases to function, silver is probably not your most pressing problem. Food, water, medicine, energy, community relationships, and personal security are far more critical in a genuine collapse scenario than precious metals. The idea that you will be trading silver coins at some post-apocalyptic marketplace is romanticized in a way that does not reflect how actual societies behave during crisis. In historical collapses and hyperinflationary episodes, people trade practical goods, establish barter networks, and often adopt whatever currency replacement emerges, which in modern contexts has sometimes been cigarettes, alcohol, foreign currencies, or other things long before anyone started using silver coins at the local market. Third, and this is a more optimistic point, the global financial system has demonstrated remarkable resilience. 2008 was genuinely terrifying and came closer to a complete financial breakdown than most people realized. And yet the system survived, was patched together, and has continued functioning. That does not mean it will always survive future stress tests, but it suggests that the extremes of the collapse scenario should be held with appropriate uncertainty, not with the confident certainty that some silver promoters project. None of this means you should not have some physical silver as part of a broader preparedness strategy. Having some money outside the banking system and intangible assets is a reasonable thing to do for a variety of moderate, realistic scenarios that stop well short of full collapse. Power grid outages, regional economic disruptions, banking system stress, high inflation, all of these are plausible scenarios in which having some physical silver provides some measure of optionality and security. The key word is some. A reasonable allocation to physical silver for preparedness purposes is very different from betting the majority of your net worth on a collapse scenario. Let me talk about where to actually buy silver if you decide it makes sense for your situation, because the dealer landscape is genuinely confusing and there are bad actors out there. The premium you pay and the quality of what you receive varies enormously depending on where you buy, and I want to give you some practical guidance. Online dealers are generally competitive on price and convenient for standard purchases. Established, reputable dealers include APMEX JM Bullion, SD Bullion, Provident Metals, and Kitco. These companies have long track records, competitive premiums, and good customer service. You can compare prices across multiple dealers on sites like Silver.com or JM Bullion's comparison tools to make sure you are getting a reasonable premium on whatever you are buying. Premiums vary by product. Standard silver rounds from private mints typically carry the lowest premiums, followed by 10-ounce and 100-ounce bars, with sovereign coins like the American Silver Eagle, Canadian Maple Leaf, Austrian Philharmonic, and others carrying higher premiums because of their official government backing and recognizability. Local coin shops are worth knowing about even if you end up buying online most of the time. A good local coin dealer can be a valuable resource for information. They sometimes have products that are not available online, and buying locally avoids shipping costs and time. The downside is that local dealers often have higher premiums than online dealers, particularly in areas where competition is limited. If you have multiple coin shops in your area, shop around. Get comfortable with the people there. Ask questions. A dealer who is willing to educate you without pressuring you is one you can trust. Avoid buying silver from non-specialist sources like eBay, Facebook Marketplace, Craigslist, or from individuals you do not know without a way to authenticate the silver. Counterfeiting is a real problem, particularly with common 1-ounce silver rounds that are easy to replicate in tungsten or other metals. If you are buying from individuals or secondary sources, you need to know how to authenticate silver, testing with specific gravity measurements, using a strong magnet, or using an ultrasound tester. If you do not know how to authenticate silver, buy from established dealers who guarantee authenticity. Be very wary of anything that sounds like a deal that is too good to be true, silver offered at or near spot price with no premium, silver offered at significant discounts, numismatic silver being sold with claims of massive future value that sounds like a sales pitch rather than investment advice. There are legitimate numismatic collectors who understand the market, but the idea that some old commemorative coin is going to be worth 10 times its silver content because of its collectible value is more often a sales technique than a real investment opportunity. For most investors, stick to standard bullion products, rounds, bars, and common sovereign coins, where the market is transparent and liquid. I want to spend some time talking about what a thoughtful, well-constructed position in silver actually looks like, not the fantasy version where you buy everything you can afford and wait for the moonshot, but a real disciplined portfolio, integrated approach that gives you silver exposure while managing the risks I have been describing. The first principle is to decide how much of your overall portfolio should be in silver before you buy a single ounce. This decision should be made in the context of your entire financial picture. What is your emergency fund situation? Do you have high interest debt? Are you investing in your retirement accounts? Are you building equity in real estate? What is your overall asset allocation? Silver should not be your first investment, your primary investment, or in most cases, even your largest alternative investment. If you have not first covered the basics, a solid emergency fund, adequate retirement contributions, appropriate insurance, then silver is probably not where your next dollar should go. If you have those basics covered and you want to allocate something to precious metals for inflation protection, portfolio diversification, or preparedness reasons, then a position of 2% to 10% of your investable assets in precious metals as a category, including both gold and silver, is a range that most financial professionals would consider reasonable, though obviously this varies by individual circumstances. Within that precious metals allocation, how you split between gold and silver depends on your specific goals. If you are primarily interested in the monetary hedge and inflation protection, gold has a stronger historical track record. If you are interested in the industrial demand story and more volatility in exchange for more potential upside, a larger silver allocation makes sense. The second principle is to build your position over time rather than all at once. Dollar cost averaging, buying a fixed dollar amount of silver at regular intervals regardless of price, smooths out your entry price and removes the temptation to try to time the market perfectly. Buying 100 or 200 worth of silver every month over a year gives you an average entry price that is much less likely to be catastrophically ill-timed than going all in at a single moment. It also removes the emotional intensity from the decision, which I think is genuinely valuable in a space where the community can drive emotional decision making. The third principle is to understand what your exit strategy is before you enter. This sounds basic, but most people who buy silver have not thought it through. Under what circumstances will you sell your silver? If it reaches a specific price, if a specific life expense arises, if you need the money in retirement, if the gold to silver ratio falls below a certain level indicating that silver has become expensive relative to gold? Having some pre-defined answer to this question, even a rough one that you might update over time, is much better than having no answer at all. The people who get stuck holding silver indefinitely at a loss are often those who bought with vague intentions and no exit plan. The fourth principle is to avoid leverage. Do not borrow money to buy silver. Do not use credit cards or personal loans to buy silver. The volatility of silver makes leverage genuinely dangerous. A 30% drawdown happens faster than you would expect, and if you are leveraged, that drawdown could wipe out your entire position and leave you with debt on top of it. Physical silver bought with cash you can genuinely afford to have tied up for a multi-year period is a very different and much safer proposition than leveraged silver speculation. I want to address some of the specific arguments that silver bulls make because I think it is important to engage with them seriously rather than dismissing them. Let's take the argument that because so much silver is consumed industrially and lost, above ground stockpiles are being drawn down, and this will eventually create a supply crisis that sends prices exploding. This is a real structural dynamic, and I do not want to trivialize it. But supply crisis arguments have a history of being true in principle while being premature or misapplied in practice. Markets are adaptive. When prices rise, exploration increases. Old deposits that were not economical at lower prices become worth developing. Recycling rates improve as the economics of recovery improve. Industrial users look for substitutions or efficiencies. The silver market's structural constraints are real, but the market's ability to adapt should not be underestimated. Let's take the argument that governments and central banks are going to return to some form of gold or silver standard, making precious metals monetary assets, once again in a formal sense. This argument is very popular in certain political and economic circles, and I understand its appeal. But the practical reality is that returning to a hard money standard would require governments to accept enormous constraints on their ability to respond to economic crises, which is precisely why the world moved away from the gold standard in the 20th century. It is possible in some future political environment that something like this happens, but betting heavily on a specific political outcome that has not occurred despite being predicted for decades is a high-risk strategy. Let's take the SLV manipulation argument more seriously for a moment. The idea that the COMEX, the primary futures exchange where silver is traded, is a mechanism for price suppression has been around for decades and draws on real regulatory concerns. The documented JP Morgan spoofing case proves that at least some manipulation occurred, but the inference that silver should therefore be at 200 or 500 or 1,000 per ounce is not proven by the existence of manipulation. Commodity markets have many participants, including the end users of silver who want low prices, electronics manufacturers, solar panel producers, etc., who have every incentive to push back against price spikes. The balance of forces in the market includes actors with interests on both sides of the price, and the idea that a cabal of banks has been keeping the price artificially low for decades, despite the enormous profit they would make from taking the other side of that trade, requires some skepticism. Let's talk about one more thing that I think is critically important and that almost never gets discussed in silver content, the opportunity cost question. Money you put into silver is money that is not going into something else. Every investment decision is simultaneously a decision not to invest in other things. And the other things available to investors over the past decade or two have included things like the S&P 500 index, which has delivered extraordinary returns. Stocks obviously have their own risks, and past performance does not guarantee future results, but the sheer magnitude of the returns from broad equity index investing over long periods, including total returns from both price appreciation and dividends, means that the opportunity cost of holding silver is very real and very large. If you had put money into an S&P 500 index fund in 2011 instead of silver at its peak, you would be looking at genuinely life-changing returns compared to what silver has delivered over that same period. That comparison is not always fair. 2011 turned out to be both a peak for silver and a great entry point for equities, which is an unusual coincidence. But the general point stands: silver needs to work hard to justify its opportunity cost when compared to other available investments. That does not mean you should never own silver. It means you should be clear-eyed about what silver needs to do to justify its place in your portfolio relative to alternatives. This is especially important for younger investors. If you are in your 20s or 30s, time is one of your most powerful assets. Compound growth over decades is staggeringly powerful. Money allocated to silver, a non-yielding asset that you are hoping will appreciate, is money that is not compounding in equity markets. The bars and coins sitting in your safe are not generating dividends are not reinvesting earnings, are not growing through the compounding mechanism that makes equity investing so powerful over long time horizons. For younger investors especially, the opportunity cost argument is a serious one worth grappling with honestly. Now, none of this means silver is worthless as an investment. It means silver has a specific role that it is well suited for and some roles that it is poorly suited for. Silver is a reasonable hedge against inflation and currency debasement, particularly over long periods. It is a reasonable component of a preparedness strategy in modest allocations. It is an interesting speculative play when positioned around cycles, buying when sentiment is low, premiums are compressed, and the fundamental demand picture looks strong. It is a legitimate store of value in physical form that exists outside the banking system and has intrinsic value that does not depend on anyone's promise. These are real attributes that have real value in a diversified portfolio. What silver is not well suited for is being your primary wealth building vehicle. It is not a reliable inflation hedge over shorter periods. It is not a guaranteed safe haven in crisis periods, as 2008 demonstrated. It is not going to deliver the kind of consistent, compounding returns that most people need to build long-term financial security. And it is not without costs, storage, insurance, premiums, spreads, and the higher capital gains tax rate all eat into your actual returns. I want to close by giving you something practical, a framework for thinking about whether silver belongs in your portfolio right now, and if so, how to approach it. Ask yourself these questions honestly. Do you have a fully funded emergency fund? If the answer is no, silver is not your next move. An emergency fund should be liquid and stable, not tied up in an asset that can fall 30% and may be hard to sell quickly. Do you have high interest debt? Credit card debt, personal loans above a certain interest rate. If you have these, paying them off almost certainly offers a better guaranteed return than silver speculation. Are you maxing out your retirement accounts? The tax advantages of 4-to-1s and IRAs are enormous. Getting the maximum contribution and any employer match should come before most other investments. If you have those bases covered and you have additional investable capital, then the next question is, what is your reason for wanting silver exposure? Is it inflation protection? Is it preparedness? Is it speculation on the industrial demand story? Is it portfolio diversification? The reason matters because it determines the right form of silver exposure: physical for preparedness, ETF for portfolio diversification, miners for leveraged speculation, and it helps you define appropriate allocation size and exit criteria. If your answer is because silver is about to go to the moon, or because the dollar is going to collapse, I would encourage you to examine that more carefully before committing money. Those are narratives, not investment theses. An investment thesis has a mechanism, a timeline, a catalyst, a target price, and an exit plan. If you cannot articulate all of those things for your silver position, you are following a narrative rather than executing a strategy. If you can articulate a genuine thesis, I am allocating 5% of my portfolio to silver via the PSLV ETF because I believe the gold to silver ratio at 85:1 is historically extended and represents an opportunity for silver to outperform gold over the next 3-5 years as industrial demand from renewable energy and EVs grows, and I will reassess at a 50:1 ratio or in 5 years, whichever comes first. That is an investment thesis. That is a thoughtful, bounded, defensible position that treats silver like an investment rather than a lottery ticket. Silver can absolutely be part of a smart, well-constructed investment portfolio. But the way it is most often sold to retail investors through emotional narratives about collapse, manipulation, and imminent price explosions is not the way smart investors approach it. Smart investors understand the full picture, including the risks, costs, and opportunity costs. They size positions appropriately. They have exit criteria. They do not let social community dynamics override financial analysis. I made this video because I want you to be one of the smart investors. I want you to understand what you are buying, why you are buying it, how much of it to buy, and what to watch for. Silver is not the enemy. Ignorance about silver is the enemy. And if you have made it this far in the video, you are already ahead of the majority of people who will buy silver this year based on nothing more than a YouTube thumbnail and a forum post. Do your homework. Read broadly. Talk to people who hold different views. Test the arguments you find most compelling. Size your positions conservatively. Plan your exits before you enter. Keep silver in proportion to your overall financial strategy rather than letting it become the centerpiece. And whatever you decide, whether you buy silver, sell silver, or decide to skip it entirely and put your money somewhere else, make that decision from a place of genuine understanding rather than fear, excitement, or social pressure. That is how you build real financial resilience, regardless of what silver or any other asset does in the market. If this video helped you see something in the silver story that you had not seen before, please share it with someone who is in the middle of making a decision about precious metals. Not because I want more views, but because the information in this video could genuinely change the outcome for someone who is about to make an uninformed decision with their hard-earned savings. That matters to me more than anything else. Take care of your financial future with the same seriousness that you take care of everything else important in your life. It deserves that attention, and you deserve to make decisions that actually serve you rather than serve someone else's interests.